Welcome back to part 2 of this week's content. We're looking at chapter 3. We're looking at pages 36 to 49 for week 4. To continue from part 1, we're now going to be looking at example 3a, which is focusing on the proverbial accounting equation. Just remember, when looking at the accounting equation, we spoke about O equals A minus L. They're just using W to refer to wealth. Okay, wealth is owner's equity. Owner's equity is the correct accounting term to describe the wealth that a business or an individual would have. So, O equals A minus L. That's the accounting equation. Worth is described by owner's equity. So, when you calculate any individual or any business's worth or owner's equity, you would need to know how many assets do they have versus how many liabilities do they have. If the assets are greater than the liabilities, then they're in a good financial position. Okay, so the worth is determined by looking at assets and liabilities. That's very important to note. So when looking at A equals O plus L, which is the general accounting equation, if I rearrange that equation and make O the subject, then I've got O equals A minus L. So it's important to know how to apply basic mathematics to get all these different equations. The textbook's very good. They show you the accounting equations. Owner's equity equals assets minus liabilities. All right, remember, when looking at basic mathematics, okay, you can take amounts to the left or the right, depending, and you can rearrange those equations. If I rearrange the equation and I make assets the subject of the equation, then obviously assets equal owner's equity plus liabilities. All right, so they're just describing that here in the textbook. They haven't shown the last one, which I showed you earlier. I am going to show it. Liabilities would be assets minus owner's equity. Right, so effectively there's 3 separate equations. Okay, A equals O plus L, L equals A minus O, and O equals A minus L. Right, those are the 3 separate equations. Just making either O the subject, A the subject, or L the subject of the equation. That's all. Okay, and then you've obviously got a working to do. Subtract, add, or subtract, depending on which you're calculating. All right, so why do we need the accounting equation? Well, if you look at the textbook's content, they describe the importance of being able to interpret transactions. They're talking about recording transactions and applying the accounting equation, because the accounting equation is the basic understanding when looking at the double entry rule. Right, so remember, Chapter 3 is focusing on the accounting equation and the double entry, and that's what we're going to be focusing on. So just remember that in all accounting transactions, there's always going to be 2 sides to every transaction. There will always be a debit side and a credit side. If you recall, okay, from our basic rules, the debit side is the left and the credit side is the right. And that's it. It's as simple as that. It's not going to change. Even CAs at the highest level in terms of accounting will be using the same left-hand side and the right-hand side of an account. Right, so an account will have a left and a right. Accountants refer to debits and credits because can you imagine how silly they would sound if they were talking about lefts and rights? Right, that doesn't happen in reality. They refer to debits and credits. That's what they use to discuss the accounting equation's impact on, or the transactions, I should say, the transactions impact on the accounting equation. Okay. So we need to first look at the business entity rule. Okay, so what is the business entity rule? Well, if you look at the note that the textbook has provided you with, they've identified the accounting principle known as the business entity rule. So what is that? Well, you're obviously going to be looking at the business. NB, business. Okay, we're not going to make it personal. Okay, there's a saying in business, keep it professional. Okay, don't mix personal and business. Okay, don't mix emotions with business. Obviously, you're not going to reflect your personal affairs, okay, in business, right? Because it's separate. The business must be kept separate from personal. Okay, you're not going to combine the two. Here's the business, there's the personal stuff. Okay, so we're outside the business. If we give the business capital, the business will have capital from the owner. Okay, there's a contribution, and the business will have money in the bank. Okay, so when you read this paragraph, just remember that everything is going to be viewed from a business's perspective. In other words, from the entity's perspective, not from the individual. Okay, no one cares about the individual, okay, when we're looking at accounting. Okay, when we're looking at the accounting, we only care about the business. Okay, we want to know, how does the business operate? What is the income? What is the expenses? What are the assets? What are the liabilities, etc. Okay, obviously the owners can change depending on what type of business I have. Okay, so you've seen different types of businesses. Okay, you know that there are companies, both public and private. Okay, when dealing with a company, obviously the shareholders can change, but the business will continue operating. Okay, so how do we approach different transactions? Well, the textbook describes each transaction separately, and they show you workings that are applied to the accounting equation. So let's have a look at them. Transaction number 1 says, Andrew starts a business and opens up a bank account, Super Surfboard Center, and transfers 50,000 out of his personal bank account into the business's bank account. Remember, everything is going to be from the business's point of view. Right, so what is happening here? The owner is making a contribution. If the owner makes a contribution, you should be thinking about that, capital. How is the owner contributing capital? In the form of cash. So that's bank. All right, so you've got bank and you've got capital. All right, so let's think about it logically. If the owner is contributing cash to the business, is the business getting more or less money? They're getting more money, so bank is going to increase. Okay. Is there a capital contribution? Yes, the capital contribution has increased. The owner's giving more. Okay, so there's going to be an increase for capital. Then we need to apply that to the accounting equation. So earlier on in the actual textbook, you were given a set of rules. Let me just quickly page back in the textbook, the hard copy of the textbook. And I just want you to remember in terms of context. Okay. There's a note here about the accounting equation, and then they spoke about assets and liabilities. Okay, so if I'm looking at what's happening to these accounts, okay, remember we said definitions are key. Okay, rules, definitions. Right, so what is bank? Bank is an asset. Okay, what is capital? Capital is part of owner's equity. It belongs to the owner or affects the owner. Right, so what is happening to the assets? Going up, plus 50,000. What is happening to owner's equity? Plus 50,000. Right, so you can clearly see here that the business's assets and its owner's equity is increasing, and that's the interpretation. Right, so make sure you're able to interpret transactions correctly. If you can interpret transactions correctly, you'll be able to complete the accounting equation. So that's example number 1. That's transaction number 1. We will look at more examples, and this should get easier, and with more practice, it'll also get easier as well. Okay, here's another example. Example number 2. Okay, transaction number 2. SSC now takes 20,000 Rand of the business's money in the bank account and purchases surfboards, which Andrew intends to sell to his new clients. Okay, so what's happening here? Let's think about it. If you had to interpret the transactions correctly, obviously the business is basically taking money out of the account to buy surfboards. And this company is obviously going to be selling those surfboards. So what do we call surfboards that we're going to be selling? Inventory. Okay, what did I use to buy the inventory? Bank. Right, so again, apply the logic. If you're using money in the bank to buy surfboards, money is going to decrease. If you know you're buying inventory, the inventory is going to increase. So you should show plus 20,000, okay, inventory going up, and minus 20,000, bank account going down. Right, it's as simple as that. It's interpreting transactions. It's understanding what's happening in terms of the accounting record-keeping process. Okay, so that describes what's happening in the accounting equation. Both bank and inventory are both considered assets. So your assets are going up and your assets are going down. You're using money to buy inventory. So there's a decrease here for the bank, and there's an increase there for the inventory. Here's another example. Right, so what's happening in this example? Well, in example number 3, if we read it together, it says SSC purchases surfboards for 70,000 Rand from a new supplier that allows them to purchase the surfboards on credit. That's very important. See the word on credit? Now we know that this is a transaction that's going to affect our liabilities. So you're buying surfboards. You should know that surfboards is inventory because it's going to be sold. Right, if I'm buying more surfboards, what happens to the inventory? Well, inventory is an asset, so it's going to go up. Okay, inventory asset going up, assets going up 70,000. Okay, I purchased 70,000 Rand worth of inventory, my assets are increasing. There's the increase in assets. Okay, what did I use to buy the assets? I used credit. Okay, so if I'm buying on credit gives rise to a liability. Okay, because you owe the creditor. Okay, so if you owe the creditor, you have an increase in the liability. Okay, you're going to owe them more. You're not going to owe them less, right? Okay, you'll owe them less if you had to pay them, but you're not paying them. Okay, you're buying from them on credit. You're promising to pay. Okay, there's an obligation to pay. So your liabilities will go up. Okay, so in this scenario, assets are going up, liabilities are going up. Here's another transaction. What's happening here? Well, SSC sells 60,000 Rand worth of surfboards that they have on credit. That's important. Okay, so now I'm selling and it's on credit. So I have a sale. Okay, selling on credit. If I sell on credit, do I get any cash? No, I don't. But I have someone who owes me, and that person's called a debtor, okay, or debtors. Right, so if I'm selling 60,000 Rand worth of surfboards, they have on credit for 100,000. Okay, the sale is going to be 100,000 because I'm increasing my income. Okay, and my debtors is an asset. I'm increasing my asset because people owe me. So 100,000 will increase the assets, and 100,000 will increase your owner's equity. Okay, owner's equity will increase because you're generating more income. And who's entitled to the income? Obviously the owner. And then we need to look at the opposite. Okay, so if I just change color, what was the cost of this of the surfboard? 60,000. That was the cost. Okay, that's the cost of the sale. Okay, so cost of sales, you've actually seen it before in terms of one of the discussion points, okay, regarding different types of accounts that can arise for a business. Okay, that came up in one of the activities actually, okay, which we'll obviously look at in more detail. Right, so just to keep it simple, the cost of the sale. If I'm selling something and it costs me 60,000, okay, what's happening to my cost of sale? It's going up. I have a cost. The costs are increasing. And then what's happening to my inventory? It's decreasing because I'm giving away the stock, okay, because I'm selling it. So inventory is an asset. The asset will decrease. There's minus 60,000. And my cost of sale is an expense. So I need to record an expense. The expense is going to decrease my owner's equity. Right, my owner's equity will decrease because of an expense. Okay, the expense is increasing. And then we have another example here to complete. Example number 5, transaction number 5. What's happening here? Well, the business pays 2,000 Rand in cash for electricity. Right, so what happened? We paid. Okay, so if I pay, bank is going to be affected. The bank we know is an asset. If I'm paying someone, if I'm paying them, I'm obviously going to use money. Okay, I'm going to pay money, so my money will decrease. Okay, so assets will decrease. Assets will decrease. Look how easy that is. Okay, notice how logical this is. You're literally interpreting transactions as is. If you're paying, assets decrease. You have less money. Right, what did you pay for? You paid for electricity. So my expenses, I'm going to record more expenses because I didn't have an expense, but now I do because I'm paying it. I'm paying the electricity. Right, so because I'm paying the electricity, I need to record an expense. That expense is going to decrease my owner's equity because my expenses are going up. Okay, more expenses means less owner's equity. So expenses go up, owner's equity decreases. So you've got a minus here under owner's equity. Activity 3E is for you to try. Please make sure that you've attempted it. See if you'll be able to complete activity 3E using what we've just looked at, those basic accounting equation analysis. In other words, which accounts do I have? Are those accounts increasing or decreasing? And how does that affect the accounting equation? Right, so that wraps up this particular section. Again, just in terms of content, please make sure you've covered up until page 49. Make sure you've done all the activities because we will be reviewing those activities either in the live session or via live Zoom. Thank you for watching this video. See you in the next one.